Greetings, members, one and all of the Salivation Nation. Understanding gold's recent performance. Let's explore. Gold has enjoyed a fairly stable run, although we have seen some dramatic movement in price in recent weeks to the downside, and I believe we may see it fall further. But nonetheless, there's only so much movement that gold does in the market. Typically, it does hold its own compared to other commodities and even silver. The gold to silver ratio is very wide right now. But nonetheless, gold is a metal that I think many of us want to understand the movement in price. You know, I've talked about on this channel, and others have as well, about some of the reasons why gold goes up and down. And typically, two of the biggest drivers outside of the psychological aspect is the dollar index and the bond yields kind of play a role in the price performance of gold. But nonetheless, we're going to take a look at some answers to questions asked by folks to the World Gold Council. And they have actually have this article here explaining gold's recent performance from some of their point of view. But keep in mind, the World Gold Council is obviously biased towards gold. Keep that in mind. Nonetheless, it's kind of what they do. They do look at the price and the performance and what causes the change in price over time, especially given the pressures from economically and that we're facing these days with modern monetary theory, with a great reset that's probably going to be coming soon. We've got inflation running very hot. You've got geopolitical factors at hand as well. So let's see what they have to say about some of this stuff in this recent article here. Gold has come under pressure since mid-March, when it was within a touching distance of its previous record high. Since then, gold has fallen over $200 an ounce, finding some support at the $1,800 an ounce level. For recent weeks, net long positioning on the COMEX has been declining, and global gold ETFs have witnessed sizable outflows. Against this change in sentiment, they address at the World Gold Council four of the most frequently asked questions by investors. Number one, given both equities and bonds have been declining, should gold have performed better than it has? Gold has proven valuable for investors given the broader macroeconomic context. It remains one of the top returning assets year to date, especially for non-US dollar investors. That's true. You look at other currencies around the world and gold is doing just fine. And by the way, silver's not doing too bad either. It has also done significantly better than would be expected based on real rates and the dollar. Furthermore, when put in context of asset performance over the past 3 years, it has protected capital and served as a source of liquidity. Keep in mind, it was about August of 2020 when it did reach that record high, and it wasn't that long ago that we saw it. So in many minds, especially compared to what it was before the pandemic, gold is doing just fine. And looking at it compared to other currencies, it is often important to consider how gold has fared in local currencies. For non-U.S. investors, gold has performed between 2% and 17% better. And that is a testimony to the strength of the dollar, by the way. But keep in mind that we're one currency away from seeing gold hit record highs again. Here's the chart that shows in some of these other currencies that you see around the world, their return in key currencies year to date. Look at that, the US dollar, not much, but it's still a little bit of a return. And record high was 2067. And the euro, it's got a 9.7% return. Look at the yen, all these other currencies out there. Pretty amazing. Gold has outperformed what simplistic models suggest. A commonly used model based solely in the direction of the dollar and real rates suggests gold should have been 21% lower than it is now, according to this chart here. But last year, they highlighted the pitfalls of relying on such a simplistic approach. First, gold's correction correlation with the dollar is not always negative. We've seen this correlation flip to positive over the past few months, as it has done in the past. Second, rising interest rates can make gold less attractive if they raise the opportunity cost and reflect higher economic growth ahead. Neither of these appear to be true at present. Growth expectations are falling and the opportunity cost, is correctly viewed in real terms, remains historically low. So yes, there are exceptions where gold does perform inversely with the dollar index. In other words, the dollar strengthens and gold rises in price. Prior to 2022, investors had bought gold in record amounts. 2020 saw a surge of gold investment, yet even before the world was besieged by COVID, investors were flocking to gold, with 2019 posting the third highest annual inflows into global gold ETFs. So when the question of gold's performance comes up in 2022, the answer is that for many investors it has already done what it needs to protect their capital in a crisis. We also saw that recently with some of these central banks buying gold, and now there's a fear that some of them could sell it. Gold carries a liquidity premium, and in a sell-everything environment, some investors often sell what they can to meet redemptions or margin calls. Given gold's often preemptive move higher to such an environment, it lends itself well to the task. We saw this phenomenon in 2008 as gold sold off in March in what that year, but rallied back in October to a new uptrend and a positive return for the year. With a growing appetite and need to yield, investors who are moving down the liquidity curve to long-term, hard-to-liquidate assets are finding that having some gold on hand is even more important. Indeed, and by the way, I'm using their terminology about investors, but I like to think of it as a hedge. The second question is, will Fed rate hikes temper the appetite for gold as a safe haven? At its most recent meeting on the 4th of May, the Fed raised interest rates by 0.5 percentage point and importantly indicated that future rate hikes are unlikely to exceed that magnitude. Rates will continue rising, but at a more gradual pace than had been expected. Given the level of inflation, it is highly likely that real rates will remain negative. Analysis of gold's performance during the different U.S. real interest rate scenarios shows that gold thrives when real interest rates are negative, but isn't hampered when they are between 0 and negative 4%. Gold is better at reducing portfolio risk during periods of moderate real rates, as it benefits the lower volatility and correlation to equities relative to periods of negative rates. The gold's performance under negative and moderate interest rate conditions. So we can see there it's annualized monthly return 17.92. With a moderate real rate, it's 8.79. And so they're pretty interesting indeed. The Fed, along with many other central banks, appears to be playing catch-up in its attempt to control inflation. If the economy was weathering the prospect of higher rates better, then the story might be worse for gold. But stagflation risks are mounting with every data print, which is supportive for gold in our view. And even if you see the price subside a bit in the immediate aftermath of these rate hikes, I think it's not going to take too long before the writing is on the wall and stagflation will hit, because the stock market is being hit hard now. And I think that's because they're realizing, hey, they're not having this liquidity injection from these stocks that the Fed has been pumping in there. And that means that the real world is coming. What that's going to look like is anybody's guess, but some people are predicting a pretty severe downturn. We already are seeing the precipice of a bear market. The third question, can you explain why gold and oil seem more correlated recently? Oil and gold have become more positively correlated over the past year or so. While this happens from time to time, the long-term correlation between the two is generally close to zero, sometimes oscillated between negatively and positively correlated over the last 25 years. For example, the correlation turned negative at near the start of the pandemic, when oil settled at a negative price and gold rallied 25%. That's right, gold went up and oil was actually about negative $38 a barrel. It actually cost money to store at the time. The rationale for the recent positive correlations centers around heightened geopolitical uncertainty, which has not only boosted the performance of commodities, particularly energy, but also gold specifically, in its role as a hedge. As we've discussed previously, gold often lags other commodities in reflationary periods. That's important to note, folks. That's been the case with prior recessions and prior economic hardships, especially the crisis of 2007, 2008. It took a while, folks, and we're there again, I think, in a different way. And, you know, they say, as I've mentioned before, that history may not completely repeat, but it often rhymes. It's almost a cause and effect situation where commodities move higher, creating inflation that some investors hedge with gold. And there's gold's positive correlation with oil has strengthened recently. There's that chart. The final question is where is central bank buying headed? We talked about this in some recent videos here. During a turbulent first quarter marked by geopolitical crisis and surging inflation, central banks globally added 84 tons of gold to their reserves. While this is 29% lower year over year, it is more than double the previous quarter, and in the main reflects buying by a few emerging market central banks. The healthy level of demand corresponds with the findings of our 2021 Central Bank Survey. For the first time, respondents highlighted gold's performance during periods of crisis as the top reason to hold gold. Look at this, folks. This is quite telling here. And so this is something that is going to push and pull as to whether or not they will sell, especially in the example that I mentioned with the Bank of England here. Performance during times of crisis, you can see it's highly relevant, and even the somewhat relevant is a very high marking there with well over 75%. It's only marginally relevant by others and not at all. That's the top of the line there. Historical position is also even more important for being highly relevant for these central banks to hold gold. But even the somewhat relevant is still up into the upper 70s there. And then you've got the long-term store of value. A no-brainer there. That is actually the most important, for highly relevant for all these central banks to hold it. It is a long-term store of value. That's why these central banks hold it. To me, this is the takeaway from this video, folks. Long-term store of value. This is why I am not of the mind to sell my gold, because I want to hold it for the long term. I have an ounce of gold that I bought for $350, folks. Still got that ounce of gold today. That's long-term wealth preservation. Effective portfolio diversifier, for sure. No default risk, lack of political risk, for sure. That's an important thing. A highly liquid asset, tier 1 asset, as noted by the Bank of International Settlements. Serves as a valuable collateral, yep. Policy tool, yeah, there you go. It's part of the policy. Part of a de-dollarization policy. Now look at that one. That's actually the lowest of all of the measures here. But that's probably what China and Russia are one of the reasons why they're accumulating gold, for that reason. Anticipation of changes in the international monetary system, that should be a big one, much larger, because there's going to be big changes coming with the global reset, with Klaus Schwab, and Prince Charles, with this ESG tied to it. These central banks, they better be holding their gold. They're beginning it, because that's where we're heading. And it's going to affect whole nation states, I believe. Looking ahead, gold might attract further interest as a diversifier as central banks seeks to reduce exposure to risk amid heightened uncertainty. We expect central banks to remain net purchasers in 2022. However, slower economic growth and rising inflation may restrain this demand in the short term. Again, codifying or further bolstering the argument that I made before that, hey, some of these banks may actually sell off some of that gold. I would encourage us not to do that. Indeed. We also caution that active management in reserves can result in selling during crisis to take advantage of gold's abundant liquidity. Only if you need to. We should be our own central banks, and sometimes when we do that, we have to act like the central banks, and sometimes there is a need to sell. And if that is there, that's what your gold is going to do, what's going to serve as a highly liquid asset in times of necessity. Hopefully, you don't ever have to worry about that. We'll see what happens, though. But fascinating questions and answers here. I agree with actually most of this information. Again, you got to take a look at the source for all this stuff. This is the World Gold Council, by the way. Same thing with the Silver Institute. They're bullish on the metals. And I like to be somewhat contrarian and challenge the status quo, even if the status quo is within the alternative side of the financial media. So I'd like to extend a multitude of gratitude to you all for taking the time to watch and encourage you to please rate, share, comment, and subscribe.